With the rising rate trend, which of course has been in investors' mind now for many years, but it really hasn't come to fruition, it's sort of been people feeling like the boy who cries wolf, but now it's really here. So what we would say, let's be cognizant of that as an investor. What we've begun to see actually is strategies that investors have looked to for income have really been hurt first. So we're starting to see emerging market strategies in the fixed income market be hurt. High yield, dividend ETF. These are areas where investors have looked to help them with income, but now they're underperforming. So I would say for investors looking to have the benefit of income, you really have to be a bit more specific about what you're looking for. So for example, look towards strategies in the fixed income market that may give you the benefit of some floating rates. So investment grade floating rate notes, senior secured loans that actually see the potential income increase as rates rise, as opposed to bonds that have a fixed rate, which tend to actually underperform. In the equity market, investors are looking toward rising rates and actually beginning to say, hey, maybe value-based strategies, those looking for undervalued companies, might finally do well because it's been a growth market for 10 years. So a little bit more clear what to do in the fixed income market. I think in the equity space, because of the rising rates compounding with volatility, we're going to see a lot of push-pull relationships as we head into the summer months. Many dividend-based strategies have exposure to securities that actually are very bond-like. So consumer staples and utilities are, for example, these are called bond-like stocks because they tend to have higher dividends than other sectors. But what's interesting though is that those tend to perform worse in the face of rising rates. So for investors looking for dividend strategies, you want to peel back the onion, examine what's under the hood and say, hey, does my dividend-based ETF have a lot of consumer staples and utilities? Will it actually perform well or poorly in this environment? Maybe look toward dividend-based strategies that have a different filter to identify securities that have high dividends, but aren't just reliant on those that are historically very bond-like, which may perform worse. Now's the time to begin to think a bit differently about what maybe you had been doing in the previous few years.